Every morning, headlines declare that India is the fastest growing major economy on earth. But when you look outside the average citizen's front door, the financial reality points in a completely different direction. On paper, the national metrics look flawless. We see booming stock markets, a top tier global GDP ranking, and soaring modern infrastructure that projects immense wealth. But when you zoom in from those heights to the ground level, a contradictory picture emerges. Here, highly educated graduates are spending their prime years standing in endless queues fighting over a handful of basic jobs. For those who are employed, the pressure isn't much lighter. Monthly salaries remain stubbornly flat, while the cost of everyday life, from cooking oil to children's school fees, keeps climbing, pushing average households into a cycle of debt. Growth in the aggregate does not guarantee prosperity for the individual. A rising gross domestic product often obscures the fact that the citizens living inside that economy are struggling to keep pace. When national wealth expands on spreadsheets but wallets stay empty, the data is signaling a systemic anomaly. The country might be winning the global headline race, but the internal numbers show something far more concerning. The nation is slipping into a lower middle income trap. How exactly did India capture that fastest growing title? Did the economy suddenly find a new gear and accelerate past the rest of the world? The data shows that the national growth trajectory hasn't experienced a sudden surge at all. For over a decade, it has remained relatively flat, hovering steadily in the 6.5 to 7% range. India claimed the lead by holding steady while its primary competitor fell away. As China's growth plummeted from 10% to 4.5%, India's consistent 6.5% performance was enough to take the top spot by default. That deceleration is driven by structural exhaustion next door. China faces a collapsing real estate sector, leaving entire cities of empty concrete structures without buyers. In a race, you take the lead when the athlete ahead runs out of breath. India passes a fatigued competitor without increasing its own speed. Relying on an opponent's weakness masks the reality that the domestic economy is hitting a structural growth ceiling, an invisible barrier that caps progress until deep systemic reforms are made. There is no denying the sheer mass of the national economy. By total GDP, India officially ranks as the sixth largest in the world. But total economic size is a mathematical illusion if you don't account for the population. We have to shift our focus from the size of the entire pie to the size of the individual slice. This chart shows what happens when you take that massive national wealth and divide it by 1.4 billion citizens. The per capita income falls to roughly $2,500. Think of it like a massive joint family business. The total revenue is enormous, which earns the family high social status in the neighborhood. But when you divide those profits equally among 140 family members, each individual is left with pennies. Looking exclusively through the lens of aggregate GDP creates a dangerous mirage. It hides the fact that on an individual level, the nation remains at the very back of the line of lower middle income countries. To understand how sticky this trap is, we have to look back at the 1970s. Back then, economists coined a term that is still used today to describe the era's stagnation, the Hindu rate of growth. This was not a religious term, it described a deeply flawed economic engine. Shackled by heavy bureaucracy and the license raj, the economy was crawling at 3.5%. It was a systemic failure to produce wealth. Modern India has solved that specific problem. The country is highly successful at producing massive amounts of wealth. The failure today is how that wealth is distributed. This divergence is driven by a mechanism known as a K shaped recovery. The top arm represents the ultra rich and large conglomerates, whose wealth is rocketing upward. The bottom arm represents the vast majority, the middle class and small businesses whose financial trajectory points downward. You can see the K shape physically built into the geography of major cities, where sprawling makeshift settlements sit directly in the shadow of luxury high rises. The old trap was about failing to make money. This new distribution failure has created a modern version of the Hindu rate of growth. The nation hasn't escaped the cage of economic stagnation. It merely upgraded the bars to gold. Breaking through that structural ceiling requires a strategy that goes beyond pumping up the stock market and relying on the IT sector. The economy needs qualitative, broad based growth built on three specific pillars. The first pillar is a massive structural shift toward labor intensive manufacturing. Highly automated factories look good in promotional videos, but the country urgently needs industries capable of absorbing millions of unskilled and semi skilled workers who are currently sidelined. The second pillar focuses on the type of work being created. Relying on the precarious, temporary contracts of the gig economy won't build a strong middle class. The focus has to shift toward generating dignified, sustainable employment. The third pillar requires a reallocation of government spending. It means moving away from short term political freebies and pouring heavy investment into human capital, specifically public health, world class skills training, and schools. Until a 7% national growth rate is visibly reflected in the daily living standards and bank accounts of average citizens, holding the title of number one ranking is a statistical illusion. True prosperity depends on whether the country remains content with a high tech facade or chooses to undertake the difficult structural shifts that actually reach its people.